So again, why doesn't somebody tell me what's going on with Bed Bath and Beyond? What do you guys talk about? What are some of their challenges with their competitive advantage? Yeah.
I mean, for one, they were very short-sighted. They thought they found something that worked, and then they thought they'd stick with that instead of.
So what turned out to be short-sighted for them?
Not keeping up with the internet was the biggest one.
Okay, so the world was moving to online, and they kind of dug in with brick and mortar. Right. Why else was that problematic for them? What exacerbated that choice? Yeah.
Pandemic.
Yeah, the pandemic. I mean, it was kind of like a double barrel shotgun because first, they long term weren't going with the trend, and then two, the pandemic forced people to go online. They didn't really have a good online alternative, and that really accelerated some of their disruption. Right? But I don't think that was their only challenge. So what else was going on at Bed Bath and Beyond? Yeah.
They held on too much on too much inventory.
So talk to me more about the inventory. What was their plan?
It said that they always want to serve the customer, and so they had a massive inventory instead of being like just in time.
Yeah, so they was willing to carry excess inventory in the name of helping the customer, but that got very expensive. And then the other problem is, what if they had the wrong inventory? Then suddenly they have to go liquidate all the stuff that we aren't buying anymore. And that became a financial challenge and a burden to them. What else? Yep.
They talked about how the customers kind of got addicted to the 20% off coupons. They were like selling things at steep discounts, but that became the standard rather than like an incentive.
Yeah, I can tell you personally, the only time I used to ever go in there is with my coupon. And I would buy 20% off and then I'd leave. That was my goal. And so that worked, but the problem is, as you said, they started getting addicted to it, and then as their margins suffered, and then they were discounting off the lower margins, it really accelerated some of their financial challenges. What other big challenges did they have? Because the article talked about they hired a guy from Target, and they made a big bet. What was the bet they doubled down on about 3 or 4 years ago? The what?
The share buyback.
So the share buyback, that would be separate, but they bought back $1 billion worth of stock. Now, where did the cash come from to buy back this $1 billion worth of stock? Because they got big negative free cash flows and not much cash. That has to do with their big debt that they have. And by the way, remember last week we're talking about there's two things you can do with your profits. You can either reinvest it or you can pay it back. When they buy back $1 billion worth of stock, how much is left for reinvestment? Hardly any. So that's the point. They chose big payouts in the middle of all of this rather than reinvestment. So in terms of being able to transform their business, whether it's building online, new store experience, whatever, there's very little money to go into that because they were buying back all their stock. Okay, so they weren't really investing in the franchise. But they also, as I said, they made a big bet. They hired essentially the chief merchandising officer from Target to become their CEO. What was their other big bet? How are they going to get out of their trouble? What was their part of their turnaround? Yeah.
The stock buyback.
It wasn't just the stock buyback. It had to do with the guy from Target. Yeah.
They wanted to make products private label.
Yeah, it was a big private label strategy. So if you ever go to Costco, you'll see the Kirkland brand all over the place. That's their private label brand. Okay? And it's actually probably the most successful private label brand in the United States, Kirkland. Right? Matter of fact, Target has a lot of private label brands, and they've done very well. So I think Bed Bath & Beyond basically said, look, let's do private label brands. We'll make more money than if we have to pay premiums to some of the suppliers. But the problem was it cost a lot of money to build these private label brands because people go into the Bed Bath & Beyond, they haven't heard of these brands before. So suddenly you see all these brands that you've never heard of at low prices, and you're not thinking quality. You're not thinking, I want to go buy this. And so that was their problem, is that they weren't investing to help educate the customers in these private label brands. And so when they ditched the premium brands that you were used to seeing, and then you brought in all the private label brands that nobody'd heard of before, it kind of turned off their customers. And that's been a problem because they didn't make the investments that were required to do it, and it's been a source of frustration. Okay, so part of the reason I wanted to tell you about this article is because when we illustrate that competitive advantage is transient, and we're trying to figure out how long things last, you can see in a matter of 5 years how Bed Bath & Beyond went from pretty good retailer to on the verge of bankruptcy. All right, and this was a once proud company in terms of what they were doing with their heritage. But the second reason I wanted to show this to you is when we talk about EIC, like this is what explains the competitive advantage or lack thereof. And so these are the types of things that you should be talking about in your PowerPoints and your write-ups and understanding about the company. Like it's not just regurgitating numbers. Anybody can do that. What do these numbers mean? What's the story behind the numbers? What's the story that's going to change these numbers? And so this is a really good narrative that when you read this, it comes really clear about why the company has been struggling. Okay? Or this could be another story about why the company is being very successful. And so that's the point. When we talk about semiconductors and Intel, this is the type of data that we should be pulling out. And when I talk about kind of curating multiple sources to put together a story, that's what separates good from bad, all right, from the analytical standpoint. That's what we need to practice more of, which is why I want to show you an example of this. Does it make sense? By the way, on a personal note, really quick, today I got 2 emails from Bed Bath & Beyond. There's the $20 off coupon. But actually, they switched this. Instead of 20% off, now it's $20 off if you spend $80. But I thought it was kind of interesting because I was just flipping through this email really quick. Save $30 on Calphalon, the Ninja blender, the Keurig coffee pot, the Green Mountain and Dunkin' Donuts coffee, the SodaStream soda mixer, and 50% on clearance items. What's true about all those things that I just told you? Are those their private label brands? No, they are not. What are they trying to push now? The original premium brands that they were trying to get out of because people weren't buying the private label. Now they're basically having to spend money to convince you to come back in to buy the premium brands, oh, by the way, that are now on sale with a coupon. Okay? So again, they're kind of all over the place with their strategy. And it hasn't really been a consistent message, and it hasn't even been a consistent theme. Okay? And that's been a problem. And that's why I asked, has anybody actually been, he said he was at one, but anybody else been to one of these stores recently? Yeah. What's been your personal experience?
Well, the woman in front of me was kind of interesting. The woman in front of me, like, they went like a separate coupon, and she basically just like left everything. And like,
She just got frustrated?
she just like didn't actually buy anything that she wanted to buy because the coupon didn't work.
So basically couldn't do the coupon, abandoned the whole purchase?
Yeah.
That's interesting. Source of frustration. What about the store itself? Like,
Honestly, I think I'd do the same.
like when you were looking around the store, was it
It's empty.
empty?
Yeah.
In what way? People empty or merchandise empty?
Kind of like both. It's kind of like abandoned a little bit.
Look like an abandoned store. So kind of like a store in The Last of Us. So just out of curiosity, did you find what you were looking for?
I did, yeah.
You did? Okay. So you knew what you wanted, it was there when it was there? All right, you were probably one of the lucky ones. I've heard a lot of stories where people have gone in, they can't find what they want because they didn't have it. All right, which has been more of an experience. But nonetheless, the fact that they're missing a lot of stuff, probably have inventory in the wrong stuff, and frustrated customers, that's not what you want to hear if you're trying to turn around a company. All right, so let's talk about semiconductors. So E in the EIC for Intel, RV, markets beta, you should have had a screenshot that looks something like this. And so did you say about the sort of overall sensitivity of the industry economically? Is this industry sensitive to changes in the economy? How do you know?
The beta is low.
The betas, which beta?
The raw beta is lower than that, which is the 0.03 difference.
That's not the beta we're looking at. When we're talking about the industry, we're not looking at the 0.97. I'm talking about the industry right now. Yeah.
Pretty sensitive. 1.52 means 52% more sensitive than.
Yeah, so this is with a 1.52 could be a much more sensitive. So why is it more sensitive? You had your hand up. Why is this a more semiconductors? Why is semiconductors more sensitive to the economy?
I said that they're not really an essential item, and so like in downtimes, it's more likely that companies that invest or like buy from them won't be like getting that much items from them. And then really good times for innovation reasons or differentiation, they'll more likely invest in those.
Okay, and so back to the downtimes. If you think about it, right now we saw ECFC last week, 65% chance of recession. I know the U.S. had some surprising job growth on Friday, but nonetheless, we've seen some pullback in the tech stocks. And the reason why there's pullback in the tech stocks, I'll give you an example. If you look at this morning, Dell Computer, which is a big customer of Intel, company news, they reported that they're going to slash 6,500 jobs on plunging PC sales. And if you read through the article, it basically says Dell's going to now have less workers than at any time since 2017 because the fourth quarter demand evaporated. They got a huge glut of inventory, and they're expecting tougher times in the next year. But again, same idea, is that just like semiconductors, particularly this part of Intel's customers, people stopped buying PCs in the fourth quarter. They don't seem to be picking up right now. Yes?
So I interned at Dell this last summer, so they were kind of explaining how they were cutting back. They also have like a hiring
The layoffs, they had a hiring freeze.
So like when I applied for my job, I let them go by hiring freeze. And then they also were talking about that. So now that laptops that they like send to someone and take like the color or like specs of it, they now take it back to the warehouse and then give it to Best Buy. It's like no one's buying anything anymore. So they're using like the whole laptops and then selling them to like Best Buy.
So a lot of discounting there in the marketplace, which again just is trouble for Intel because Intel is trying to sell Dell and other companies new chips, and if Dell's struggling with their chips, then they're going to be buying more from Intel. And so that was the point. Like, as this is a lead into the five forces, which is the current five forces, if you look at the last year, was actually pretty favorable. But almost overnight, those conditions are starting to deteriorate for the semiconductor industry, particularly on the retail side. And it goes back to high economic sensitivity. And as we go into a little bit tougher economic times and demand is now more equal to supply, we're seeing a different industry going forward than we have in the past. Okay. Also, in terms of that macroeconomic sensitivity, we noticed that Intel, she pointed out correctly, has a lower beta than the industry. Why? Why is Intel a little less sensitive than some of their competitors? Why is their beta, you think, a little bit lower from an economic standpoint? What makes Intel a little less sensitive? It's still sensitive, 0.97. They're still going up and down with the economy. But why aren't they like 1.52? Why are they much lower? Yeah.
I said that in the semiconductor industry, there's so many companies in that, so they only make up such a small share, so they're not getting as hard when the semiconductors are getting cut or earning as much.
Okay. So think about it a slightly different way, which is Intel's in a lot of different segments. Okay. And so Intel is a diversified semiconductor company. And so even though the PC market isn't doing well, if you read through the data, one of Intel's businesses is actually doing really well. What was that? What's the one area that's growing fast for Intel? That's been a big source of success. Yeah.
Is it like government or cloud?
Cloud is growing, but I read something even more specific when we were looking through the BICO and the industry reports. It's a business called Mobileye. What is Mobileye?
autonomous driving?
Yeah, so the business is people are building, cars are essentially, AI-driven robots on a go-forward basis. Like my car. My car, it's not a Tesla, has all these automated features, lane guidance, it's got, adaptive cruise control, it's got some steering, can do some self-steering for a little while to keep me in the middle of the lane so I don't automatically drift over to the next lane. It's going to actually auto brake if it senses a problem. And interesting, as I was driving in today, it said my camera was dirty and all that was disabled, which really upset me. But the point of the story here is that cars are increasingly using a lot of these specialty chips. And that's been one area for Intel that they've actually done well despite the consumer PCs falling down. So I think their diversification is mitigated some of their particular economic sensitivity, right? Whereas if you're just a one-trick pony and then consumer PCs go down, well, there's nowhere you can go. So I think that has helped Intel versus some of their other brethren. But nonetheless, this is an economically sensitive industry. That was the important thing. Okay. Now then we go on to the I, right? For custom RV spread. So we look at our spread template, and then we notice that this is an attractive industry. That the ROIC was about 18% as it loads here, and the cost of capital was around 10. Just takes a second to load. So 18.67 ROIC against about a 10.69 WACC. That's about an 8-point spread. So when we do the 5 forces today, like why? Why in the last 12 months was this industry having such a high spread? That was positive. Which of the forces, you had to talk about all 5, but which of the forces really helped this industry? What'd you say? Buyer power, supplier power, barriers to entry and exit, substitutes, rivalry. Which of those forces were favorable? I see you're kind of scratching your head, but I'm assuming that means a hand raise. So which of the forces were favorable?
But favorable to the industry going up.
Yeah. Why does this industry have a big spread of 18.67 against 10.69?
Probably because there's increasing supply of semiconductors.
Well, if you have increasing supply and nothing else changes, that should hurt the industry, right? Because there's more supply for the same demand. That doesn't help the spread. So why is the industry spread last year so good? Yeah.
Would you say that supplier power is low? They have the raw materials and chips, the semiconductor manufacturers? I guess
So suppliers don't appear to have a lot of power. Matter of fact, if you looked up suppliers, their biggest supplier is a company called Tokyo Electron. And if you did a DES on Tokyo Electron, you quickly find out that they make the equipment that they sell to people like Intel to actually make the chips. And their global spread is very attractive, right? So it appears that their suppliers, unlike Boeing and Airbus, they're not using their monopoly power to hurt the chip makers. It's kind of like more co-opetition. We make money, you make money. So we're allowing you to make more money because we're making money as you try to grow and buy a bunch of our stuff. So the suppliers don't appear right now to be influencing a lot of power over the chip makers, and that's been favorable to the chip makers.
Is it because the buying power?
And the chip makers probably have a lot of buying power because flipping this around, Intel represents, 13% of their CapEx is Tokyo Electron, and 50% of Tokyo Electron's revenue goes to Intel. So I'm willing to bet if we looked at companies like that, they're buying big from companies like Tokyo Electron, and that also allows both sides to make more margin. So the point is the suppliers don't appear to be hurting the spread, and probably that lack of competition amongst the suppliers, and probably the nature of the unique business, because it's hard to change the suppliers, but nonetheless, it doesn't appear to be hurting this industry right now. So what about the other forces? Yeah.
So I have a question about that. So when I was looking into it, I realized that even though there's a lot of suppliers on the SPLC analysis, most of the suppliers sell a niche part that only they make. So don't they still command some power because
Theoretically, yes. So I'm saying if there's just a niche and you got nowhere else to go, that should hurt you. But the question is, does it appear to be hurting this industry right now? They don't seem to be exercising that power. And that's the question. So the point is, could they exercise the power? Maybe, but they're not exercising the power because sometimes it works in the other direction. Meaning, yes, I'm important to you, but you're my only customer. So it's kind of like a suicide pact. Like if you screw me, you got nowhere to go. And if I screw you, I got nowhere to go. So we could become almost codependent on each other. And that might be what's happening here with the semiconductor players, which is why the suppliers are not exerting a lot of power, because where else are they going to sell to? There's only so many people they can sell. Does that make sense? Yeah.
The threat of new entrants pretty low as well, because there's a lot of research and development and capital that goes into
So huge barriers to entry.
Yeah.
So big R&D, which probably means patents and IP, which is often protected. What's another big barrier to entry with all that? How much does it cost to build a new semiconductor facility called a fab plant, fabrication?
A lot.
Tens of billions of dollars. So these are not cheap things to build and require huge amount of engineering know-how, huge amount of technical know-how, and lots of money. Okay? As a matter of fact, there's also tremendous barriers to entry from a government standpoint. Right? You're not building a next chip plant in Taiwan without the government's permission. You're not going to do the same in China without the government's permission. Increasingly in the U.S., you're not going to build the U.S. without the government's permission, because the U.S. and Europe are spending heavily, CHIPS Act last year, to try and get more production here. So that's actually subsidizing some of that cost, but nonetheless, there's some barriers to opening up plants. And that tends to help the profitability of this industry. What else? Yeah.
It's also not easy to be substituted, because since they give a lot of R&D, they got patent, they got very good chips, and you are very hard to find another good chip. Even you find another good chip, since this is a high technology, it's going to cost you a lot of things. We call that switching cost.
Yes.
So
The switching cost can be very, very high. So again, a couple of years ago, for example, Apple tried to get Qualcomm kicked out of the iPhone because Qualcomm's a monopoly. You're making too much money. We want to change the RF chip. So what we're going to do is we're going to partner with Intel to build a competing chip to Qualcomm. That was a spectacular failure because Qualcomm had too much intellectual property, too many patents, and it was really hard for Intel to learn that business. So eventually Intel sold the business to Apple to loss. And Apple's been trying to do it themselves and failing. In fact, they just announced that they were probably going to try the Apple version of the chip that Intel couldn't do in 2023. They pushed it out to 2025 because they're having no success competing against Qualcomm's chips. And so that's the point. The intellectual property, the uniqueness of some of these chips, not easy to copy. And that tends to help some of the chip makers. Matter of fact, when you tried to buy cars last year, again, if you tried to buy a BMW, you lost the ability to buy touchscreens last year, the 3 and 5 series, because there weren't enough chips around. And it wasn't easy for BMW to just source other chips for their touchscreens. So when they couldn't get the chips for the touchscreens, they just took them out of their cars. And you couldn't have a touchscreen in a 3 or 5 series BMW because there weren't any chips around. So again, it's back to the uniqueness of some of these chips. Yes?
I was going to say BMW started producing them in-house.
They're trying to scramble to figure out a solution in their supply chains. But in the short term, it's been a benefit to the chip makers. So substitutes were hard, right? Suppliers didn't seem to have a lot of power. Barriers to entries were pretty high. And we were touching on rivalry. There isn't a huge amount of rivalry historically in the business because they're all in their niches. And essentially, there was huge demand, particularly driven by the pandemic, for chips relative to the supply. And so if you could make a chip, you could sell it to anybody. So there wasn't really reason to discount and cut the price, which meant that the buyers during the pandemic didn't have a lot of power because there were so few chips to go around. You bought what you could at whatever price you could because it wasn't easy to just flip to something else, right? So that's why this industry was doing pretty well last year. Is any of that going to change in 5 years? Like, are we going to have the same spreads in 5 years? It's going to be better or worse. So are the forces going to be the same? Or any of the forces going to change? So that's the important part of the story. What do you think is going to happen over the next 5 years to any of these forces? Yeah.
That I think might happen is there might be an increase in buying power just because of the increasing like international strain between U.S. and China. Like for example, because of the Chip Act, U.S. manufacturers can't sell to Chinese buyers, which limits the buying pool inherently. And if there is like a retaliatory response, then the same thing could happen over there. So like that could.
Yeah. So if these trade wars and trade barriers start getting pretty severe, that could have some disruption of the marketplace and take away some of your markets, which could hurt the buyer power, right? Or give more buyers power because you have fewer people to sell to. What else? What's going to happen to barriers to entry over 5 years? Yeah.
I'm sorry, I was gonna talk about rivalry.
Sorry, a little louder.
I was gonna talk about rivalry.
Go ahead. What's going to happen to the rivalry though?
Well, I feel like now it's when I was because their market share is only 2.3% compared to the other competitors. I mean, it's still like good, like fifth highest market share, but still, like their revenue growth is going up, but their profitability is like only moderate. So I feel like that might have a negative impact on them in the long run if their expenses are also increasing to where their profitability is not at the same rate.
Okay, so there's a lot of talk in the articles as well, if you read through, that margins will be under threat. You know, because it depends on how much growth you have. Because here's the point. If the pie is growing and we grow with the pie, that's easier to do than the pie is not growing and we grow by taking somebody else's share of the pie. Okay? And so if the growth starts to moderate and we have to go fight for share with other competitors in the industry, then the rivalry will start to intensify. And the rivalry intensifies, it's going to put pressure on the margins of the PC makers. Right? In fact, same thing with the cloud. You know, one of the areas that has been growing is the cloud. Right? But the problem for Intel, which we'll get to, is that it's also become more genericized. Like people are buying cheaper chips for the cloud and scale, hyperscale computing. You don't need the specialized chips for Intel to do cloud-based computing. And so that growth has actually gone away from them. They used to control 99% of the server market. I think they're down to like 60% of the server market, which is more on the competitive advantage side. But just the point is that you are seeing some commoditization across some of these markets. Right? I also think substitutes become more viable for a different reason. Do you guys use Google Docs? When you're using Google Docs, do you care what chip you're using? Do you care about the server? Do you care about the hard drive? Right? You just care that Google Docs works. And so I think as we go into the cloud, that's one of the problems, is that basically substitutes, the commoditization of the hardware is being replaced by software. And software is playing a more prominent role than hardware. And increasingly, I think AI is going to play a more prominent role in that software than the hardware in of itself. Although there'll probably be specialized chips for those AI, so those companies might do well. But if you're just generic, that's going to become much more commoditized. So I do think that some segments of the market will probably do really well, but overall as an industry, you're probably seeing some substitutes which start to threaten some parts of the industry. Although the other parts of the industry is automobiles might be a growth business. The mobile market could be huge. So you can come up with a couple of different stories about what happens in 5 years. But just like the Bed Bath & Beyond article, you need to do that. Like that's what we said, whether you're writing a paper, whether you're talking in your PowerPoint, I want to hear more than just the number. I want to hear some rationale for the number. And 5 years, I know none of us can predict the future. And I want you to say stupid shit. Okay, I'll ding you for that. But I want you to come up with realistic, you read all this information, a realistic point of view about what could happen in the future. That's what the analysts are trying to do. And it's not unanimity. So we're not going to grade you on whether we agree with you as long as you kind of follow the process and you make it somewhat fact-based. Or you can make inferences based on what you see. That's what we want to continue to practice. Make sense? So back to the C. Does Intel have competitive advantage today? All right, if you remember the data, they clearly do not. I'll put back up the RV screenshot. They have a negative spread in an issue with a positive spread. Okay, their ROIC is like 2%, if I remember correctly, against a cost of capital of around 8%. So they clearly, with a negative 6-point spread, lack competitive advantage compared to an industry with a positive 8-point spread. All right, so why? What's been challenging to Intel? Yeah.
It's, it's not really participating in the smartphone market. race among smartphones, but Intel's really capitalizing on that. And smartphones, the smartphone market is like 3 times the amount of the PC market.
And how much does Intel play in the smartphone market?
From my understanding, okay.
Almost nothing. And AMD has basically spent on chips, which are now, for the same price point, more powerful with better battery, lower energy utilization than Intel. So AMD actually has better technology in some cases than Intel. And on the servers, as I said, companies for servers are not using Intel chips for their servers. They're using other chips that are cheaper at scale with the mass utilization of those chips. So I could take 100 chips that are generic and using software become more powerful than a couple of Intel chips. Okay? As a matter of fact, the one area of the PC market that has been doing fairly well is Apple. Like, this is a $2,600 MacBook Air. All right? These are not cheap computers. There's no Intel in here. Okay? Apple uses its own processors. They kicked Intel out of it. Right? The only thing they're using Intel for is the Thunderbolt standard, I think, is Intel's. But other than that, they have very little hardware in the areas of growth in the marketplace. And that's not where they were 10 years ago. 10 years ago, their whole marketing campaign was Intel inside. You cared that your computer had Intel in it. That was their whole point. Now, who cares if Intel has it? It works. It's faster. As a matter of fact, this machine is much faster with the M2 from Apple with much higher battery life than a corresponding Intel. I'd rather have an 18-hour battery life. Like, does any of your PCs that you buy for $700 last for 18 hours? I doubt it, right? And that's part of the problem that Intel's had. They don't have differentiation anymore that they used to at the high end of the marketplace. And as a matter of fact, somebody I think said in the first section today, she said, I think Intel's been resting on their laurels. Like, they were kind of the king of the technology. They just rested on their laurels. In a way, kind of like Bed Bath & Beyond. That's what made me think of that article, is that Bed Bath & Beyond kind of rested on their laurels. They had a model which was working for them in 2017. And when the world started to shift, they just doubled down. They doubled down on their retail stores as the world was moving online. And their timing couldn't have been any worse when the pandemic hit. But even if the pandemic didn't hit, I'd still think they're on the road to decline if they're doing retail in one channel when everybody else has moved to omni-channel, and particularly driving online. They just didn't really have much of a presence. Yeah.
Is there a reason why Bed Bath & Beyond stock is booming 50%?
Well, that's all relative. Look at where the stock price was a couple of years ago versus where it was today. So right now, they're just basically trying to figure out the type of bankruptcy they're going through, when they're going to go bankrupt, and if anything's going to be left when they go through bankruptcy. I would stay away from that stock.
Why are people buying it?
Why did people buy GameStop in the Robinhood crowd? I don't know. But you know what? You guys have the Bloomberg Trading Challenge. You want to go play in this? It's still above $3. You can play in Bed Bath & Beyond stock, but there's hyper risk there. Personally, I would avoid. Okay. But back to competitive advantage. Right now, they don't seem to have competitive advantage. They've kind of lost it. One area they seem to be doing well in, as they said, is their Mobileye and their mobile chips, which is a growth vector for them. But it's just a small part of their business right now. It was like $1 billion of sales or something like that. But what about 5 years from now? Where are they going to be in 5 years? Are they going to turn it around? Are they still going to be kind of struggling with below average spread? Are they going to get back to the industry average? What do you think? Are they making the right choices that Bed Bath & Beyond clearly didn't make over the last 5 years? Because Intel knows that they need to do something different. Are they going to pull it off? What do you think? Because that needs to be part of your answer to the competitive advantage. What did you say for the competitive advantage in 5 years? What did the analysts say that you're reading about? Yeah.
I don't remember what I said, but I think they should kind of stop competing, not stop competing, but maybe stop trying to fight competition in the semiconductor industry and move to something that is going well for them, which is in the automotive segment and artificial intelligence.
So the automotive AI, where they're spending money, is that going to help them overcome this? The fact that the U.S. government is helping subsidize some of their big chip plants they're building in Ohio, if they have this new capacity on cutting edge technology, is that going to allow them to be more competitive on a global scale? Like, I don't know what the answer are, but these are some of the things you should at least be referring to when you talk about the next 5 years. All right, so we did the first assignment. You're probably sitting there thinking, gee, I didn't write all this stuff down. Well, this is like you had the training wheels on. I'm going to take the training wheels off. So I don't remember how you got to learn how to ride a bike, but I remember when I rode the bike and I had the training wheels off, I wasn't told that I was actually riding the bike without the training wheels. And then I freaked out, and then I crashed the bike. But the point of the story is the same thing. You're going to get really proficient really quick at doing this analysis. It just requires some practice because you're smarter than you think you are. And that's the point. I want to hear what you have to say because I know you can solve the equations and I know you can read numbers. But can you kind of put together a story on what you see to give me kind of like what's really going on? I think that's the art of valuation, and that's what we want to keep on applying this semester. And it'll differentiate you if you get good at this. All right. So on Wednesday, we'll talk more about this. But as I said, as a preview, your next assignment is going to be on Google. And we didn't do this with Intel, but we should have. So if you look at Intel here, see where it says whole firm? We looked at Intel on their data and their whole firm. But if you click on this drop down, it's got two businesses. Segment number 1 is semiconductor devices. Segment number 2 is auto parts manufacturing. Notice if I choose semiconductor devices, the pure list and the ROIC will be different than the auto parts manufacturing peers. Same Intel, just different pure list. So this sector last year made 18.6% ROIC. If I switch this to auto parts manufacturing, this sector of their business had an ROIC of 2.7%. So that should clearly show you that the 5 forces for the auto manufacturing chip part of their business is different than the traditional semiconductor business. So when we do our write-up, we should have a different RV markets beta because the sensitivity for auto is probably different than the sensitivity for general semiconductors. 2 screenshots. We should have 2 screenshots here for auto parts and the semiconductor hardware. And then we should have essentially a write-up for each. Okay, so we should have had a write-up on what's going on for E and the I in each of those 2 segments. So essentially twice what you did. Does that make sense? So when you do Google next week, also known as Alphabet, you're not going to do it on the whole company. You're going to see that Google has 3 businesses: Internet Media and Services, Infrastructure Software, Application Software. So in a sense, 3 E's, 3 I's. Today, future for the I's. So 6 screenshots, 3 5 forces. Okay? So that adds more complexity. Now this is going to be important because when you do your PowerPoint presentation in 2 weeks, I'm going to give you a multi-segment business, which means you're going to have to do it in 10 minutes, the summary of all this analysis. All right, so you have to be proficient and practice in order to get it all done without running out of time. But this is the other important part, is that we don't usually get, omni businesses. Increasingly, businesses are in multiple areas, and different parts of their businesses are attractive and grow at different rates. Okay, so just a little hint on your next assignment. This is homework 3. Questions about that? Yes, sir?
I have a question about this page.
Mm-hmm.
Usually it shows like a bunch of companies, like 10 companies, but the market cap weighted average is actually not the average of all those companies. If you're trying to sum up all those numbers, it is not the market cap weighted average.
No, it's not just, they don't just add and divide, it's a weighted average. Everything on this page is a weighted average. That's why it's called a market cap weighted average. If you choose in settings, global settings average, it'll average them. But this will average based on size, so it's a weighted average. And so I don't really care as much about the market cap weighted average, but what I care about is I don't want some company that's real tiny here, like for example, Meta no, that's a big company, other side of the scale. Bumble, which is a $5 billion market cap, versus Google, which is a $1 trillion market cap, they represent a much bigger part of the market. So their high rate of return in a much bigger part of the market is much more important than Bumble's return in a much smaller part of the market. That's the idea of the market cap weighted average. Okay. All right, so again, continue on with your trading competition. Wednesday, I'll give you your team project that you're working on. You're welcome to start on homework 2. It's due next Monday. And then we'll talk more and practice more on this on Wednesday's class. Okay? Have a good day. See you guys on Wednesday.